Hey, what's good, self-direct investors? I hope you're all doing great, and I want to welcome you back to my channel. If you're new here, my name is Jordan, and I'm the mind behind Make More Capital, and today we're going to cover the recent earnings releases of Canopy Growth Corp and Aurora Cannabis. Now, they released their earnings yesterday, which was Monday, November 9th, and after a lot of market momentum from the positive news from Pfizer and President-elect Biden, these companies did see some big increases yesterday, but of course today we are seeing these increases kind of fall back to what we're used to seeing out of these companies. So we're going to evaluate where they're at and whether or not at this point in time what their market cap is, whether these are good companies to invest in based on their current valuation, or whether or not they're profitable. Just basically give you an idea of where these companies are at right now, November 10th, 2020. That being said, before we start, if you enjoy this video at any point, please make sure you leave a thumbs up. It really helps out my channel, and make sure you subscribe so that you don't miss any new ETF breakdowns or any episodes of This Week in Cannabis that I drop every weekend. And lastly, if you've not opened your self-directed tax-free savings account, there are links below to Canada's top discount brokers, Questrade and Wealthsimple Trade. If you use that link, you get a bit of free money for doing so, and you can always reach out to me and I'll help you navigate the platform so that you can get started on the right foot. So without further ado, let's dive in. And Canopy recorded their second quarter fiscal 2021 results, and they brought in a net revenue over the last 3 months of $135 million. This would have been accounting for July, August, and September, ending September 30th. Now, in order to make this $135 million, though, they suffered a net loss of $97 million in order to make that. It's not ideal. You don't want to see companies losing money, but again, these are companies in a new early in a new industry, and they are still growing. So it's something that we can be used to seeing as long as revenues increase over time. Now, their adjusted EBITDA. EBITDA is a new kind of accounting metric. It's controversial, but it stands for earnings before interest, tax, depreciation, and amortization. And this is an indicator of profitability, similar to EPS, but a lot of kind of new industries use it to account for fast growth like tech and cannabis. And of course, you can see that they lost $86 million in adjusted EBITDA. Now, ideally, you want to see this positive because that means they're profitable. If it's negative, it means they're not. But I guess this is a 43% improvement versus how much money they lost last year. So small wins for Canopy. Now, they are implementing initiatives to save $150 to $2 million across their structure. So basically what this says to me is that we aimed way too high, spent way too much money beforehand. Now we really need to cut down on our costs if we want to survive as a company. Another thing that they mentioned here, they increased market share by 200 basis points in the Canadian recreational market based on their proprietary market share tracker. Well, 200 basis points is 2%. So, they wrote it like this to make it seem less of a not ideal situation, most likely. But when you consider that, and this was data pulled as of early September, I believe if we were to reference from September 11th was when I made these slides. But Canopy was at 9.9% of Ontario market share, behind Aphria, Aurora, and Redecan. In Alberta, Canopy was behind Aurora and Aphria as well. And in and Canopy, again in BC, was also behind Aphria, Redecan, and Aurora. So 2 percentage basis points for all of Canada really is not a big deal when you look at the big picture. So that's something that, once you know this, it's worth considering. But the main thing for Canopy long-term is trying to get into the U.S., and they still have that acreage deal. So we're going to dive into the numbers here. Their second quarter fiscal summary, basically compared to last year, 12 months ago now. Their net revenue is up to $135 million, which is up 77%, which is good to see. And they did increase their gross margin percentage to 19%, but unfortunately we see a net loss significantly dropped, $96.6 million. And again, their EBITDA, they're also not showing profitability in this current 3-month period. And then free cash flow, they spent and lost another $190 million. So yeah, although on the surface it doesn't look all bad, it sucks, but Canopy's just burning so much of the cash that they were given. And I'm not going to spend too much time going through all this fluff, but if you want a reference, right now they're sitting on $1.72 billion as of September 30th, 2020, representing a decrease of $254 million from $1.97 billion that they were sitting at in March. So if you actually would want to go check out this episode I did, which was Top 4 Canadian Cannabis Companies, this is episode 4 in the series I made, Reality Check Cannabis in 2020. It goes to show that the money that Constellation Brands invested into Canopy in 2018, the 5 billion Canadian dollars, it's now dwindled down to $1.7 billion. So, although it can look pretty, they've spent way too much cash in the back end, and that's something that, once you do a little bit of digging, you can see, and that's one of the scary factors long term. But again, this company is betting big on this this agreement to get them into the U.S. And they have arranged their amendment with Acreage Holdings. So pending U.S. legalization, and again, this relies on many factors, whether the Senate flips in January, we still have to wait for that, whether, who knows what Trump's going to do with these results, whether he's going to take them to court. A lot of things up in the air, but Canopy is really betting big on this because, as we can see, although they are improving their numbers in Canada, not big enough to be number one. And that's where most of the revenue is coming from. So if we look at the Canadian recreational net revenue, this recent quarter, from 1 year ago, it's up 380%. So last year at this time, they made 8.8 million. This year, they made 42.2. And then business to consumer, so this is business to business. So this would be selling wholesale, I believe, to other companies that don't have enough bud. And then business to consumer, this is what they sold in the rec market. It's not great, honestly. And in total, it brings their Canadian recreational net revenue to 60.9 million, which again, from last year is up 178%, which is nice to see. But again, we'll look at some of the breakdowns just to see. And of course, it's also with their Canadian medical, they saw a 7% increase, but their international medical revenue in the other markets saw a 3% decrease. Now, this could be for a number of reasons, Rona related, whatnot. But again, you want to see these numbers going up. But of course, with normalization of cannabis worldwide as a medicinal alternative, this is only going to increase. So their net cannabis revenue is up. Main thing though is all other revenue. I was unable to find where this was. I listened to I read through the conference call transcript. They did not actually answer what is making up all their other revenue. So this is an important thing to try and figure out. But all of this added up is their net revenue of 135 million, up 77% from last year. So they are slowly growing their numbers. And if we break it down even further, most of the money comes from dry bud. Oils and soft gels are their second highest. And unfortunately, Canopy went really heavily into the beverages. They bet heavy on the beverages, but unfortunately in Canada they were just not big sellers, mainly because of the tight regulations and the slow rollout, and this is just going to take time adjusting, but that's the reality of Canopy's play. They bet heavy in that, but unfortunately it's flower, vapes, and pre-rolls that are actually making the most money in the Canadian market. And of course they unfortunately lost a good deal of money to revenue adjustments and taxes. And then if you break down their global medical revenue, dry bud does well, but it seems like oil and soft gels are quite popular worldwide. Cannabis 2.0 products, they're not shipping much of what they're making excess of 2.0. So nonetheless, that is just a further breakdown of their numbers. And unfortunately, they don't have one of the big kind of cash burn things that I like to look at. But if we just compare this to what they did last quarter, this was end of May, I believe, and then this would have been for end of March. End of May, and then this would be for end of September. So as we can see from Q1 2020 to Q1 2021, they basically saw their revenues decrease. You don't want to see these numbers decrease this much like this. Now the good news though is, again, when we just compare 34 million, if we just compare total 49.5 million down to 44.2, it decreased by 11%. But then if we look, they've now gotten this total number back up to 60. So at least that's a nice climb from here. But when a lot of it is coming from business to business and not business to consumer, that is not ideal because you're making a lot more money on the business to consumer transactions than you are on the business to business. So anyways, that is it for Canopy. Oh, last thing I did want to touch on is that Canopy is valued at $11.5 billion. Does it make sense that a company valued at $11.5 million is only bringing in $135 million in revenue? Not really. A lot of their future value is already baked into Canopy's current share price, in my view. That's why I do not own them and I don't plan to. Now, if we jump into Aurora, one thing they can be very proud of is that they are the #1 Canadian medical producer as of right now, and they are seeing strong international medical growth. And I mean, it's good for them to highlight that because if that's where they're seeing growth, they do want people to know this. And they brought in a net revenue of $67.8 million this past quarter or last 3 months. Now, if we jump in here, we're going to look through, and their total cannabis net revenue was $67.8 million. This was a slight increase from $67.5 million the prior quarter. Now, again, does this look like a lot of growth from the prior quarter? No, it's not. So, although Aurora, brought in a decent amount of money, they're not actually growing those revenues, and that's unfortunately not a good sign. And that's one reason why I would stay away, why I don't invest in Aurora myself as well. Their adjusted gross margin remains strong at 48% compared to Canopy's 19%. Versus 50 in Q4. So it's gone down a little bit, and I guess excluding the need to ramp up one of their facilities, Aurora Nordic, this did drain a little bit of money of what margin they would have kept. But nonetheless, that's a nice thing to see. I mean, margins, you want to see them up to 48% or 50 as opposed to 19% with Canopy. And their adjusted EBITDA, their profitability was a loss of $57 million. So unfortunately, they are losing a lot of money. Their cash balance is now $250 or $250 million. So we'll see what they spent as we go through here. But their consumer cannabis net revenue was $34.3 million, but down 3%. And this is not ideal. You do not want to see Aurora losing consumer revenue in Canada, because that's where most of your money is going to come in until the world opens up to cannabis. Now, their medical cannabis net revenue was $33.5 million, which was a 4% increase. It's great to see this increasing, especially international medical business, which grew 41% quarter over quarter. So it is a sign that Aurora has executed on their international medical plays. But of course, it is very important just to consider, a lot of these factors have to line in, but of course, the end goal for companies to be profitable and to make sure you're, making money for your shareholders. Now, one thing that they've also done is tried to reduce costs. Like Canopy, SG&A is their selling general administrative costs. They've brought this down, or it was $46.9 million in Q1 2020. They brought it down by $19.6 million in their most recent quarter. So, and it appears they're also spending money on research and development. So again, you just don't want to see them wasting money on things that aren't going to give them a return on investment. But again, cutting costs is a big part of what you're going to have to do if your company was too ambitious and made too many big plays, and now have to kind of claw your way back and reduce these costs. Sorry. So reducing production and complexity through the closure of 5 cultivation facilities. Like, imagine they didn't try to make these 5 extra cultivation facilities worldwide. Unfortunately, upon further research too, you actually find out that some of the executives for this company a few years ago, their incentives was to, land funding in order to build projects in countries worldwide. So when you look into the fine print, you kind of see what drives these actions. It sucks, but this is only something I've come to learn through constantly practicing and reading this. So it's something to be aware of, though, because when you're seeing Aurora gain 40% yesterday and then lose 26%, I mean, again, fundamentally, it's a company that you probably just want to stay away from. Why? Well, if you look through the fine print, they are burning a lot of cash. In this quarter, they spent $25 million on legal settlements, contract termination fees, restructuring costs. That's way too much money, shareholder money spent. Working change capital, $37 million. More legal settlements, $47 million. So again, their past management handled cash terribly, so we can only hope that going forward they will improve this. But again, if we look at the numbers, main thing is from Q4 2020 to Q1 2021, you want to see these numbers increasing. Total net revenue has gone down 1%. Again, it's not terrible. They're still selling and making money. Well, no, they're not necessarily making money. They're still selling cannabis, but they're not increasing their market share, and that's what you want to see. And their total cannabis net revenue, again, stayed pretty much flat, but it's good to see that their medical net revenue is going up over time. But again, anytime you see numbers that are in brackets, it shows a loss over time. So ideally, it seems ideal that they are reducing their costs for SG&A, or for selling, general administrative, for research and development as well. These costs are going down over time, but fundamentally this just means that Aurora right now is not really gathering any more market share, and it seems that their total assets, their working cash capital, they are up to $201 million. So their total assets did decrease by 1% from last quarter to this quarter. But fundamentally, I mean, the thing you want to make sure is that they're gaining market share in Ontario, or in Canada, ideally Ontario, but that's something we can see that they are not necessarily doing. And if we just compare this to last year, their Q3, they actually produced the most revenue they ever had in Q3 of 2020, and they lost market share by about 3% going into Q4 of 2020. And then, unfortunately, we're seeing these numbers only go down. Right? So in this recent quarter is down to 67.8, or close to. You just want to see more growth than that. So now Aurora is a company valued at $1.3 billion. Obviously, for them to be bringing in $67 million and be valued at $1.35 billion still doesn't seem to make a whole lot of sense, right? Nonetheless, that is, a lot of their future growth is likely already accounted into their current share price. But one last thing I wanted to run through is, well, let's take a look at who is selling the most flower in Ontario right now. So as of November 9th, Ontario, I will cover this just because it is the most populated province in Canada, but Aphria is number 1 with Jean-Guy, then we've got Namaste, Redican, Flower, Pure Sun Farms, Aurora is on here at number 6, Namaste is number 7, Canopy does make their first appearance in Ontario at number 8 with their Tweed Sativa brand, and then Pure Sun Farms has 9 and 10. So although they are eating up market share, we can see that Aphria is still holding strong to the number 1 spot. And I mean, again, this is as of early September. Aphria was leading in market share in Ontario and Alberta, the top selling provinces, trailing slightly behind in BC. But again, this is why if you watch any of my other videos, you will know that I'm invested in Aphria myself. But I hope you found this informational just to walk through what Canopy is doing right now and where they're at and where Aurora's at. Because, although these companies will likely survive long term, they do have to cut a lot of costs, but they've also got to make sure that they do start increasing their market share and make profits at some point. So, and if you enjoyed this video, please make sure you leave a like. It really helps out my channel a lot. And if you don't want to miss any new episodes, please subscribe. That way you won't miss any new episodes coming out. Hope you got some value out of this, folks. I tried to keep it short and sweet, but let me know if you have any questions in the comments, and I will I'll be back next week for some updates for Green Thumb Industries, Curaleaf, and Trulieve when these U.S. multi-state operators release their earnings. Thanks so much, everybody. Have a great day.